Hi, welcome to the Elevate Market Chat. This month's episode was recorded October 24th. In this episode, Shane and I discuss 3 interviews from some of the heavyweights in the investment industry. That's Paul Tudor Jones, Bill Ackman, and Stanley Druckenmiller. They give some of their thoughts on the overall economy, the election, and we kind of discuss those and what some of our thoughts are and maybe how investors should be positioned. So, hope you guys enjoy. Hey Shane, it's good to be back on here with you. Last time I was up in the mountains and now I'm back in the office. So how have you been since then?
Man, I'm better, as always, better than I deserve, but for different reasons this time. We've had a couple of hurricanes hit my neck of the woods, as most listeners probably know, and we've had a little bit of minor damage at my house, but nothing like what has happened for a lot of my community and some immediate neighbors, but more like extended neighborhood, which people from our church are probably never getting back into their homes. They're probably going to have to be tore down when the water finally does recede, which it hasn't yet. So there's a lot of people who really are feeling major impacts from this hurricane, even here in Florida. So, and then there was the one before that, Helene, which was, had more impacts a little further north and North Carolina and places like that. So yeah, it's just we're very lucky to make it through in as good a shape as we did, and I thank my lucky stars and God for that. Um, so anyway, yeah, that's what's been going on in my world mostly. So feeling good about where we sit today.
Nice. Well, I'm glad to hear that you ended up okay, and our thoughts and prayers go out to those who were in different areas of that storm. So, but with that, couple things. Well, I guess one big thing has happened just in the last week or so in terms of commentary that's out there. 3 big names went out, spoke on the major news networks, CNBC, Bloomberg, all those. And that was, Paul Tudor Jones, who we've talked about before. He's just a legend when it comes to managing money. And then Stanley Druckenmiller. And just to give you an idea of what these guys, what their track record looks like from 1981 to 2010, Druckenmiller returned 30% annually and even going beyond that without a single losing year. So
Yeah.
that's just unheard of. And then Bill Ackman, who used to be a long short investor. He had some famous shorts. One was that I think it was Herbalife. So he certainly has made a name for himself, but they were all out talking and giving their thoughts on where we stand today and hitting everything from kind of the election and just what their thoughts were. And, most of that short term, but some interesting commentary mostly around the noise and the fact that doesn't change too many things. And the big one is our debt. We've talked about that quite a bit, but I just thought maybe we'd start it off with what was maybe your big takeaway or what caught your attention from anything that was said by those guys.
Yeah, well, just maybe to follow up on what you said there a little bit. Well, actually, first of all, we'll put links to these interviews in the show notes somewhere. So wherever you're listening to this, hopefully you'll be able to just tap a link and go listen into these interviews. But at the end of the day, like they're these are big names for sure. And when Stanley Druckenmiller talks, I stop what I'm doing and pay attention. Him in particular. The other guys, Ackman, not quite as much. Paul Tudor Jones, like you said, legendary. This guy was doing technical analysis when he had to print the charts out on a sheet of paper and like mail them to people. I mean, he was tracing stuff off of a screen with a pencil and a tracing paper. If anybody remembers what that stuff was. So I mean, Paul Tudor Jones been at this for a long time and just a legendary active trader. I think he's more of an investor now, and certainly seems to be paying a lot more attention to macroeconomic trends and um, situations. But I mean, a lot of what these guys said really just validates what we've been talking about in our market commentary for, I don't know, a year or more. Um, Lots of discussion of the unsustainable level of national debt that we have, which I sent a chart in our team Slack earlier today that our national debt has grown by over $500 billion in the last 29 days, roughly, since September 26th. We've added 506 billion dollars of debt to our load, which brings us to $35.8 trillion dollars that we collectively owe as a country. This is money that will never, ever, ever be paid back in today's dollars. The only way to pay this money back is to print the money um, to pay it, which of course is an invisible tax on all of America. Nobody gets to vote for or against this tax. They just print the money, and as they print money, our dollars become worth less, and then they get to pay back, this 35.8 trillion in cheaper dollars. This is just how the system is designed to work, and it will work for as long as it works, and then when it doesn't anymore, it'll be a real big problem. And I think that's why you're seeing interest rates rise on balance, even though the Fed is trying real hard to cut interest rates at the short end. On the shortest term loans, they're cutting interest rates, trying to help the Treasury refinance some of this debt at lower interest rates because, of course, our interest on this debt is now over $1 trillion a year. We're now spending, I think, almost as much money, roughly as much money on interest as we do on defense. Um, and none of this is going to work in the long run. And so what you're seeing happen, and I know we'll probably get into some more of this as we go, but what you're seeing happen is who wants to step in front of a $35.8 trillion freight train? You know, who would loan a government money that is never going to be able to pay you back in today's dollars? They're already $35.8 trillion in debt and growing. They're planning to run deficits of two trillion dollars a year, right? Spend $2 trillion a year that they don't have. So that both presidents, no matter who gets elected, nobody's talking about trying to bring down the national debt. They're both going to run deficits and add to the debt. And the way that we're going to get the money is to just print it all. So if you're China or if you're India or Turkey or Brazil or any of our trading partners, Mexico, why would you buy this debt? You wouldn't. You simply would not on any economic basis whatsoever. And so the fewer buyers there are for that debt, the higher the interest rate has to go in order to acquire new acquire demand, right? Acquire new potential buyers for it. So I
And
wouldn't
then
be buying any bonds
Shane,
if I were
Shane,
you.
maybe you can hit on, you and I talked about it a little before the call, but oftentimes I get this question that, well, the Fed's cutting rates, so then wouldn't, mortgages and maybe some of these other debt instruments, wouldn't those interest rates also go down? And now you're talking about how, with kind of what you were leading up to, is that these bonds look risky to foreign investors. So at what interest rate does it then become attractive? So you've kind of got two parts: what the Fed can control, and then does a buyer even want to buy these bonds? If they're on their offering, say 5%, maybe they want 10% because that pays them more. Can you maybe just kind of summarize those two or bring that in?
I don't know how simple we can make it because it can become, quite a complex thing. But the biggest thing to remember is that the Fed only sets one interest rate. That's all they control directly is one interest rate, and that is an interest rate that makes it doesn't apply to me and you and anybody listening to this call. It applies to banks that are lending money to each other on an overnight basis. So overnight is the shortest term loan there is, right? You borrow money right before the bank's closing to make sure you have enough in reserve that you don't get shut down, hence the name of the Federal Reserve Bank, right? You have to have enough in reserves in order to continue operating as a bank. Otherwise, you will be shut down. And so what you do is you borrow that money at 4 o'clock in the afternoon before you close up shop for the day, and you pay that loan back the following morning when the bank opens up. So that's the shortest term loan there is in the market, and that is the rate that the Fed controls. The idea is that because the banks will charge maybe a slightly higher rate to each other on the overnight basis, in order to to meet those reserve requirements, that will trickle through the rest of the economy. And because they're charging a higher rate, they'll pay a higher rate on checking accounts. And because people are getting a higher rate on checking accounts, CDs will end up with a higher rate. And because of that, ultimately, all the way out to mortgages at 30 years will end up with a higher rate. But it doesn't always work that way, because the Fed controls only the overnight rate, and supply and demand are what are in the driver's seat of all the other rates. And so the less demand there is for a given bond or loan of a given term, the higher that rate will have to go in order to attract buyers of that debt. So it's all a supply and demand thing. And when you look around the world, I mean, even within our own country, we counsel clients all the time on, and this isn't financial advice for anybody else, but I don't know your individual situation, but I personally don't see any good reason why anybody would want to own United States Treasury bonds that mature in any more than 2 or 3 years, at the most. Like, I wouldn't buy, if you own some already, okay, depending on what price you got and where you bought them and all that kind of stuff, maybe it's worth holding them. But putting new money to work today, I would be very cautious about lending them money for any more than 2 years, because duration is a concept that we probably don't have time to cover. But the longer duration a bond, the more a small change in interest rates will influence it. For example, a lot of banks back in 2020, was it 2020? Yeah, whenever rates were zero, right? Since the great financial crisis till over the past couple of years, banks would go and buy US Treasuries for 20 years. And some of these, like, I was looking at one that was issued in, I think, 2022, August of 2022, and it was a 20-year loan to the United States government. So you give the US government, $100, whatever, and they got to pay it back in 20 years. They're going to pay you, I think, 1.5% interest per year along the way, right? Um, this bond, you paid $100 for it, and you were going to earn $1.50 every year for the next 20 years. If you wanted to go sell that bond today, how much do you think you could get for it? Remember, you paid $100 for it 2 years ago.
Right. Well, in theory, you should get $98 and what, 50 cents.
Yeah, it's a risk-free bond, right? It's a risk-free loan to the United States government. What could possibly go wrong? If you went and tried to sell that bond today, the most you could get for it is $62. You're down, 40%. At the end of 2023, it was trading at $53. So this is a risk-free bond to the United States government, and you are now down, you lost almost half your money in 2 years. So that's what happens when interest rates go from 1.5% or zero, to say 5%. That 20-year bond is going to feel the pain, because it's 20 years that you could now get 5% for, in theory, instead of 1.5%. So that's where the supply. No, but there's no demand for this 20-year bond that pays 1.5, right? Because 20-year bonds today pay 3.5 or something like that. So why would anybody buy a 1.5% coupon bond when they could buy a 3.5% coupon bond? Well, the only way you would do that is if the price was low enough that it became attractive to you.
Mm-hmm.
So supply and demand is what controls interest rates. The Fed seeks to influence them through the one short-term rate that they do control and set. But it is absolutely not a linear relationship. And so, yeah, that's what we're seeing play out all across the globe right now. And what
Yeah.
do
So,
people want instead of the United States bonds, Kyle? Do you know what they want instead? Which is very evidenced by the price of this thing.
I'm gonna guess that it's shiny and golden. Would that be the
That's
right
right.
answer?
It is absolutely gold. So gold is up more than the stock market this year. That is usually not the case. Gold is up while interest rates are going up. That is usually not the case. So and I've been asking it in the commentary for several months. What is it? What is gold trying to tell us that it is up more than, the Nasdaq? It is up more than the S&P 500. It's up as much as the Mag 7 for the year. That shouldn't happen. Normally gold is a hedge against market losses, right? Normally people flee stocks and buy gold, and you want to own lots of gold in times of market turmoil.
Hmm.
Same thing
And
with interest rates, right? Like if gold doesn't pay any interest, as Warren Buffett famously points out. He's like, why would you own gold? It doesn't do anything, doesn't pay anything, just sits there and does nothing. Well, this year it sits there and goes up by 30% basically. And that's while interest rates have risen on balance. And so why are people buying gold instead of treasuries? It's because all the things we just talked about. So
yeah, and
own
it's
gold.
interesting. So Stanley Druckenmiller was pointing to that, and what he talked about is he believes financial markets are the best indicator, not necessarily the economic opinions or the numbers underlying those analysis that are put together. And the Fed was going to combat inflation, and right now you're seeing interest rates higher, you're seeing gold higher, you're seeing stocks higher. Everything out there seems to still be going up. I don't see a, war that has been won on inflation, and that was kind of what he was highlighting. But when you look at gold going up like this, and you and I, we call it the chaos hedge,
Yep.
and it's because when things break down. So what's kind of breaking down here is a country that is overburdened with debt, that if they lose control of interest rates, that's a tough bargain, and people are putting money into gold, which
Yep.
gold is not a fiat currency. Gold is a precious metal that tends to do well when you have inflation or chaos.
Yeah, and I put a
So,
chart in our last commentary of the United States debt maturity by year. And what's really crazy about it is like it goes out to 2054, right? So we're 30 years in the future. Um, and you would think like, I don't know, maybe you wouldn't think, but I don't know. It seems logical to me that this debt would be evenly spread out over the course of the next 30 years, right? Because the government's been issuing debt since the beginning of time, basically, and they sell 30-year bonds and they sell 10-year bonds and they sell 5-year bonds and they sell 1-year bonds and all these different debt instruments that they sell. You would think that they would control it to a point where it's pretty level, like every year, right? 1 year from now, we have basically you would take that 35.8 trillion and divide it by, say, the next 30 years, and you would have you know, I guess a little over $1 trillion of debt due every year, right? And you would just kind of refinance that or pay it off as time went on. But that is not the case. This is like what we call a waterfall in our business. Um, Out of the 35.8 trillion, 5.7 trillion is due in the next 12 months. Another 4.7 trillion is due in the next 24 or from 12 to 24 months. Another 3.1 trillion the year after that. And so the vast majority, let's see, if this is 6 plus 5 plus 3 plus 2 plus 2 plus 2, 20 trillion out of the 38 trillion is literally due in the next 5 years. And that's why the government is that's why people are buying gold and everybody's freaking out. And the government just keeps borrowing um, for 1 year at a time. Like they're kicking the can as far down the road as they can handle, but they're very afraid to borrow money for the next 5 to 7 years because they think they're gonna pay too much in interest. So that's why I think the Fed is cutting rates is because they're trying to help the Treasury out in refinancing some of this debt that's very close to maturity, by allowing them to, hopefully borrow more money at a new short-term rate and pay this off. But it's just going to perpetuate the problem because they're not extending it out for 5 or 10 or 20 years, right? It just moves 12 months into the future. And so this problem just keeps getting bigger and bigger and closer. And eventually, you know, there's only a couple ways out of it, right? One way is default, and the other way is massive money printing that leads to inflation that makes the 9% we saw a couple years ago look like a total joke.
Yeah. And something interesting, like, so Bill Ackman was highlighting in that the two ways out that he saw was, one, you renegotiate with your creditors. The other one was asset growth. And that growth, he was talking about the presidents and who might be the most pro growth, and he said Trump might be, but you know, regardless, neither one wants to cut on spending. So these ways out don't look very good. Um, I'm curious, what's the takeaway in terms of, are there any moves that can be made? Long-term debt doesn't look so good. Stocks seem like they're overvalued. I was running the numbers today. About one-fourth of returns in the S&P 500 over the last 100 years have been 20% or higher. So this has been an outstanding year if you look at it that way. And you just wonder, well, where is that next opportunity? I think gold's one of those. Um, but what are the other things maybe that come to your mind?
Well, it sounds totally counterintuitive, but here's the deal: is you're not going to have a recession when the government's printing this kind of money. It's just, like that's the one thing that I never accounted for in my analysis over the past couple of years of looking at like, oh my gosh, this is a huge problem. But when the government prints and spends the kind of money that it is printing and spending, right? It just continues to pump money it doesn't have into our economy. If you took government spending out of the equation, we would be in a terrible recession. So if that ever stops, you're going to want to head for the exits as quickly as you possibly can. I mean, you short everything, other than maybe gold. But as long as they're able to continue printing money and pumping it into the system, I would just want to own stocks. I mean, it's crazy, right? Like stocks they are not trading at reasonable prices right now. But it doesn't really matter because there's nowhere to hide. You don't, cash is going to get devalued by any type of inflation. The best investors in the world, Druckenmiller and Paul Tudor Jones, are shorting bonds, so don't want to hang out there, I'm pretty sure. The only path forward is that there's going to be massive inflation. I mean, I think I'm trying to remember the direct quote, and so I probably shouldn't say it, but I might butcher it. But I think Paul Tudor Jones basically just said, all roads lead to inflation. I'm long gold, I'm long Bitcoin, commodities are underpriced, and if I had cash, it'd be very short term.
Hmm.
That's pretty
And
much what I just said, right? So the best hedge against inflation, and I've written about this in my commentaries for years. The best hedge against inflation is a capital efficient business. And when I say capital efficient business, I mean a business that doesn't have to invest new money into factories and human resources and things like that in order to increase their revenue. So companies like Hershey that already have the factory built. They're pumping out chocolate. They can raise the price anytime they want to. Sometimes cocoa was a big impact over the past year because the rise in cocoa prices, but that was mostly weather related and has now, I think, begun to resolve itself. So Hershey shares are trading at a great price, and those are capital efficient companies. Coca-Cola is a capital efficient company, but it's very expensive. There's all types of others that lots of technology companies are capital efficient, except for all the AI spending they're doing right now to buy these chips from Nvidia. Nvidia is quite capital efficient, right? They convert a lot of their revenue to free cash flow, and then what do they do with that free cash flow? Hopefully, they share it with the owners of the business, the shareholders, through share repurchases and dividends. So, for me, it's a lot of gold, it's a lot of Bitcoin, and it's a lot of capital efficient stocks. I think that's what you want to own.
yeah, I agree. And I think the other part there is, it's not an asset, it's your taxes. You need to be looking at what your tax planning looks like, because you can bet that with deficits like this, inflation, all that, somebody's going to have to pay. And
Oh yeah.
making sure that you put the assets in the right buckets, and meet with your tax advisor and understand, well, what does it look like the next 5-10 years down the road if we start to make some of these moves to get more of that capital out of the crosshairs of the IRS, because you can bet that rates will most likely go higher. And those types of moves, they're great because you don't have to worry about the whims of the market to protect that capital. You can make those moves, and that's, I always look at it as guaranteed money.
Yeah. Well, yeah, that's more your department than mine, so I'll let you speak on that. I just pay the taxes. That's all I know. In fact, since the last time we talked, I paid my taxes for 2023 finally. I'm one of those guys who just I delay it as long as I can and keep the money in my trading account for as long as I can, despite penalties and interest, because I generally think I can make more investing my money for an extra 10 months than I can, or then it's going to cost me, right? So I just I get the extension every year and pay in October. So yep, I paid my taxes. It didn't feel good, but my trading account is a little bit less than it used to be. So it takes a little adjustment period when you take a big haircut on your investment or your
Yeah.
trading account.
And you can always too, when you're really getting strategic with the taxes there, is you can always take that money now that short-term treasuries do offer a return and you can park it there and that helps build a little value as well. So,
Yeah, you
oh,
know what I noticed though this year is that I think the either the penalty or the interest the rate that they were charging, like I think they maybe raised their interest rate because I when I got the bill this year, I was like, huh, maybe I should pay a little bit more as I go because it was a bit more expensive than it had been in prior years. I mean, nothing crazy, um, but I don't know much about that. I haven't looked. I feel like I heard something about it, but it seems like they're penalizing or probably charging more interest than they have in the past, at least that I can remember. So that might not be such a great idea going forward. And I would actually cap, kind of what I said about owning stocks and gold and Bitcoin and all that stuff, with the fact that like you got to be ready to sell um, when this thing turns around because we're not buying stocks here because they represent a good value or a good long-term investment. Like from here, like the 5 to 10 year returns. If you go look back and look at history of markets, right? When stocks trade at the current valuation levels, whether it's price to sales or price to earnings or price to cash flow or price to book, right? Any of these measures you want to look at, if you go back in time and say, okay, every time the market traded at this high of a multiple, what were the 5 year and 10 year subsequent returns? They were horrible, absolutely horrible, right? So making long-term investments in stocks at these prices is probably a terrible idea. What we're doing is we're buying the nicest house in a bad neighborhood and saying, look, I'm going to sell this thing at a moment's notice if this neighborhood starts to burn, you know.
yep.
And so I think it's important to note that like you're probably not going to make a lot of investments in forever stocks right now, like stocks that you'll be holding 10 years from now, because if you're following any type of stop loss or have any type of safety net in place, I guess that's a good way to put it. I wouldn't buy something here. I don't care what it is. I don't care if it's Hershey and Coca-Cola and Berkshire Hathaway. These are stocks that they're great businesses and they're going to be around forever. But from here, they probably all have 40 or 50% downside in them. The only question is when does it start and what level does it start from, right? So maybe they'll go up another 5 or 10% because expensive stuff can get more and more expensive before it finally rolls over. And for as long as the government is just going to keep printing money and pumping it into our economy and causing inflation, all these assets are just going to keep going up and up and up and up and up. And so it's it. I'm not saying buy Berkshire because it's cheap, or buy Hershey because it's cheap, or buy anything because it's cheap, because nothing's cheap right now. If something's cheap right now, it's probably a horrible, probably a horrible company, right? Because
And I think
everything has gone up.
I looked the other day and Peloton looked like it was one of those. So,
Peloton
um,
just did a deal with Costco, so maybe they're not going to go to zero. I thought Peloton would have gone to zero because people only need so many clothing racks in their house, which is what that exercise bike is for most people, I think.
yeah.
And COVID's of course over, but yeah, it turns out Costco is selling Pelotons, and they got some type of deal going. Uh, for what it's worth, I'd rather own Costco than Peloton, but I mean, I don't want to pay any more than $650 a share for Costco, and today Costco's is trading at $1,000 or something. Oh,
Jeez.
894, 894. So I mean it's overvalued. That it could break out and go to 1200, but Expensive stuff can get more expensive when the government's printing the amount of money they're printing that they don't have. Just deficit spending is going to cause inflation. Inflation is going to cause the price of anything that is priced in dollars to go up.
Hmm.
That's just how it's going to work. So,
Yeah,
like it or not, buy stocks.
yeah, and I think, like you say, long term stocks are the winner. It's just a matter of make sure you have the proper risk management program so that you're not just buying it today and saying, I'm going to put my head in the sand and,
Yep.
look out 10 years down
Yeah.
the road because it doesn't look good.
And also, don't just sell every time there's a 10% pullback because that's pretty normal. Like we had one of those a couple of months ago, right? And I wrote about it in the commentary and I said, look, if this goes any further, we're probably going to start stopping out of some of our best names. But if it doesn't go any further, then this is probably a real good opportunity to put some money to work and buy it aggressively for the short run. And
Hmm.
turns out that that was just a dip, and the right thing to have been doing during that was buying everything you could buy. At least till right now. Who knows where that'll go from here? But um, for now, the right move was to buy that dip. So don't just sell every time the market drops 10% either. You got to have a real strategy and a real understanding of what you own and what's reasonable and what's not reasonable. And my advice would be, as it always is, and I know yours is in agreement with this, Kyle, is that you got to have a risk management strategy. And the wrong time to develop your risk management strategy is when the market's falling and you're very emotional. You're going to
Right.
make bad decisions if you wait until then to develop your risk management strategy. I think you would agree with me in saying
I
that
would.
your risk management strategy needs to be determined before you get into something. You should know where you're getting out before you ever hit the buy button. If you don't know where to sell that thing, you have no business hitting the buy button.
Hmm. So great. Well, Shane, I know we're kind of at the end of our time here, so maybe wrap things up, but just kind of key things that might happen here or will happen before our next meeting. So we've got the FOMC meeting is November 7th. Is that on election day or right after?
I think election happens on Tuesday, so then the Fed meeting is always on a Wednesday, so it's probably the day after the election.
Yeah, so that'll be a fun week, but we've got that. I think the expectation is for a quarter point decrease in rates. I I don't think that's the best decision by the Fed, but they're going to do what they're going to do. And then our next meeting for the market chat is November 21st. So, always appreciate everybody tuning in here. Be sure to like, subscribe, share with friends, and definitely give us any feedback you might have as well. So, Shane, with that, I think we might wrap it up unless you have something else.
Just get out there and vote. I don't care who you vote for, but get out there and vote.
And I would second that notion. So, thanks again for your time, and I'll see you at the next meeting.
All right, brother. See you.
Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.